I would encourage people to hire a wealth advisor that will go select individual stocks and bonds on their behalf, because this is a serious decision, Cory.
It
And this
is.
is not something that I think people should just ride the wave and do what millions of other people are doing, because your retirement is custom to you.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Thank you. A round of applause. I like it.
So do you have any new things in your life going on that you want to share with the millions of potential viewers or listeners of today's episode?
Not so much that it's new, Jake, but I did want to share with you actually to the day that we are recording this. It was 14 years ago today that you and I started working together.
Oh, wow. Happy anniversary, Cory.
How about that? 14 years.
Good.
That made me think about you saying that you've been playing golf for 30 years.
Yeah. So I've been playing golf twice as long. So 14 years, huh? So you were a young pup. You were what, 19 or 20 years old?
I was 20.
20 years old. We started working at it today, huh? Awesome. So you started
14
working
years
during
ago.
your college spring break?
Pardon?
You started working during your college spring break?
You know what's funny is that I started working and then a week later is when I went on my college spring break.
Ah, nice.
Yes. So right there.
All right, Cory. Well, congrats. Congrats to us.
How about that? Congrats to us indeed.
So, and that was the best decision you ever made, Cory.
That's right. I tell myself that every morning.
That's good. That's good. I don't have much new to report. Rachel and I are getting ready to go to New York City on vacation. I bought her tickets to March Madness, Cory. So we're going to see round one. We don't know who we're going to see yet as of the recording of this, but we'll have round one in New York, and we'll probably go to a Broadway show, eat some good food, and walk around a bunch. She usually drags me all over Manhattan, so it'll be fun.
Sounds like a great weekend. Good for you guys.
Yeah, well, it should be good. Yeah. So again, I'm going next week from recording, so we'll probably have one more show, I guess, recording before I go. But that's the latest with me, and then just gearing up for golf season. So it's been a lot of fun. That's right.
And the Falcon Tour that's kicked off.
That's right. The what?
The Falcon Tour.
That's right. Good job, Cory. So quick plug for the Falcon Wealth Advisors Tour, which is hosted by Central Links Golf. And if anyone's interested, you simply go to centrallinksgolf.com, and all our information is on there. We're humble sponsors, but they run everything. They pick the courses. They run the events. This is real golf, though, Cory. So you play the ball as it lies, you putt everything out, and you post a score. And I really love that about it. There's none of this pick up your ball and throw it, or all these weird games or gimmies. And there's none of that going on. It's real golf on real golf courses with a really great group of people, not only hosting the events, but there's some really awesome people that I've met playing in the events as well. So we're excited to kick that off in April. And we do encourage our listeners, if you're local to Kansas City, to check it out. If you're a golfer, an avid golfer, and you want to play in a real tournament environment, these guys do a great job of making that happen. So, all right, Cory, but before we go into today's headlines, we do have a listener who emailed in a suggestion of a topic that they wanted us to discuss. So, Cory, why don't you let us know what they said?
They said, are there any Upticks programs about traditional IRAs? I'm working to learn about mine, and there's a lot that I don't understand. Thank you.
Yes. So first off, thank you to the listener who sent in that question. And yes, traditional IRAs, there's a lot to unpack and uncover there. And traditional IRAs, as chartered retirement planning counselors, Cory, are something that both you and I deal in quite often. And just to kind of define it, so basically it's an account established by the IRS that allows retirement funds to grow tax deferred, meaning if you buy and sell within this account, you're not subject to capital gains taxes in the year that you realize said gain. So it can be a really advantageous type of account to put your retirement savings in. However, there are a lot of rules and restrictions that come with them. Typically, once you put money in there, Cory, if you write it off on your taxes, you can't pull the funds out until you're 59 and a half, right? And so that's something that's very important to understand. Also, to be able to contribute to an account, you have to have earned income. And you also can potentially deduct those contributions, but you are subject to certain income restrictions. Now, many of our clients have IRAs, Cory, as a result of rolling over 401k accounts to these IRAs. And that's really what we've done a lot of our careers, 14 years now for you, Cory. But the idea is these are great accounts because they defer taxes. That's really the reason you would have an IRA. Now, you can contribute and not deduct those contributions, Cory. However, if you do that, you got to be careful because you're going to have to keep accurate records of what have you already paid taxes on and what is not paid taxes on. And it can be rather cumbersome to keep track of. So the point of this is if you want to learn more about IRAs, the best way to do that is to email service@falconwealthadvisors.com. Let them know that you want to meet with myself or Cory, and we're happy to go over your IRA account and talk about all the rules and restrictions, your investments, and help that all collaborate with a well thought out financial plan. Cory, did I miss anything? I know there's a lot there, but I just wanted to kind of answer the question and give some more thoughts to our listeners and watchers out there.
Yes, I don't think there's too much to add. I think you did a great job highlighting that and how a lot of clients of ours have traditional IRAs, and the Chartered Retirement Planning Counselor designation is something that has led you and I to talking about this nearly every day, Jake. So I think your advice is spot on.
Good. All right. Thank you. All right, Cory, let's get to our headline.
All right, let's jump
Play
into
ball.
the first. Play ball, yeah. I didn't know if that's what we're going for there or not. So, we've gone back and forth between play ball and charge. So to get us kicked off on our headlines though today, Jake, caring for loved ones. These steps could ease caregiver shortage and curb costs. What have you got?
Yeah, Cory, I wanted to include this article in today's show because it's a very common question that comes up with clients is that, Jake, first off, if you have aging parents, how am I going to help my parents pay for a nursing home or long-term care help? Or second, how am I going to help pay for myself? And it's a real problem in America, Cory. The takeaway is that the article is that, and I don't like this, but this is what the article talked about, is that there's potential government programs to support elder care. Now, we all know, Cory, as far as that's concerned, you don't want to hold your breath on that. Because we don't want to wait on the government to take care of us, certainly not in America.
Right.
Did you know, Cory, that 12,000 Americans are turning 65 each day this year?
Yes, it's like 4 million people over the next few years. It's crazy.
And did you also know, and this is a sad one, that only 10% of Americans can afford long-term care insurance?
I didn't know that, but that does not surprise me.
Yeah, again, this is all according to the article, but it's important to understand that you don't need insurance. You need a financial plan. And the reality is the average elder care worker only makes $23,000 a year. So that is what ultimately needs to change to encourage more people to take on this profession so that actually will ultimately drive costs down. So the real problem is, Cory, they can't find enough workers. So they have to drive the price up because they don't have capacity to take on these elderly people that need assistance. So my point, though, is for anyone watching or listening to Upticks is that let's develop a financial plan. Let's budget. Let's forecast what those costs may or may not be and make sure that ideally you can self-fund it first. And if not, maybe we do look at long-term care insurance or other avenues. The key, though, is it all starts with a financial plan, and I don't want you to wait for the government to solve all your problems. What are your thoughts on this? I know you talk about it a lot with your clients.
One thing that stood out to me from when you were talking about this article, Jake, and really from conversations I've had with clients though too, is on one hand, you stated the article stated there's only 10% of people that can afford long-term care insurance because we know it's expensive. We know long-term care is expensive. But despite that, the average worker is not making a lot of money doing it. Where's all the money go?
To the businesses, sadly,
Yep.
to the businesses, right? So they're trying to make a hefty margin, right? And I don't like that. And my thinking is, Cory, as more and more people, 12,000 a day are turning 65. So as those people turn 70 and 80 and 90, hopefully more businesses enter the arena, which ultimately enhances competition and drives prices lower, is what I'm hopeful for. But if you think about it, for 23 grand a year, what if you got one of these workers and said, you know what? I'll pay you 40,000 a year. Why don't you come to my house and help me out? I don't know. That's when I read this article, that's what I thought. I was like, if these companies are only paying these people 23 grand to do a very difficult job, wouldn't you find one of those workers and just say, hey, can you come help take care of me and my wife in our house, and I'll pay you 40 grand? And then you're only paying 3,500 a month versus some of these places charge 10 grand a month or whatever it is. And you get to live in the comfort of your own home. So I think, Cory, it's a great business idea for you. is to contract out these workers to just be independent contractors and go out and go to these people's homes so people can retire in place. They can have someone come to their home and take care of them, and you could do a whole lot better. Anyways, that's that whole nother topic for another episode. My point is, I think there's an issue with the system and it needs to be corrected. And it's just going to take the right entrepreneur or the right business or the right company to come in and reorganize these things, reshuffle the deck, and maybe the government will step up and maybe not. But again, I don't want to hold your breath and wait on that. Let's develop your financial plan. Let's make sure you can afford it and look at your options.
Good.
All right, good. Well, thank you. Thank you for indulging me on that topic. I think it's an important one. And a quick plug for Upticks. Thank you again for tuning in. Please like and share our content. The whole reason Cory and I are recording Upticks is to enhance financial literacy. And so hopefully the headlines that we talk about are doing that for you and your family and friends. All right, Cory, we still don't believe how much things cost. What do you got here?
The takeaway from this article was that CPI, or the Consumer Price Index, which is reported by the BLS, the Bureau of Labor Statistics, all these government acronyms. So the big takeaway here, though, is that people see CPI and the cost of living as two different metrics, because inflation, as we know, has slowed down. So the rate at which prices rise has slowed, but price levels remain much higher than they were 3 or 4 years ago. And what I thought was really interesting that was highlighted in this article, Jake, and this is a chart just for you, that we could pop up on the screen here, is just highlighting, bleach, cooking oil, milk, deodorant, et cetera. A lot of household staples, what the prices looked like a few years ago relative to right now. And I thought it was interesting. A lot of people interviewed in this talked about how they understood price hikes during the height of the pandemic because of supply chain disruptions, labor shortages, et cetera. But they viewed them as temporary, and the fact that prices have not come back down, and in fact, they're still rising, even if at a slower pace, is what's frustrated people. And I'm curious, Jake, what your thoughts are on this.
It is frustrating. Rachel and I deal with that with her business, that paper costs for magazine publishing shot up, and they haven't lowered it, Cory. And I think that's the sad reality that doesn't really happen.
I think you're right.
Think about it. The price of suits hasn't come down. Cars haven't really come down, and so I think if these companies can get away charging higher, they do it for as long as they can until sadly you get a recession and then demand decreases and then they lower their prices. So I think as long as the consumer is healthy, and it's great though, the other side of this coin, Cory, is that the consumer is healthy because unemployment is still very low. Yep. The unemployment rate is around under 4%. And so if you have unemployment low, meaning people that want to work and are able to work are getting jobs, then they can afford to pay these higher prices. It's really behavior though. It's if we as consumers refuse to pay these higher prices, then they will come down. However, that's very difficult. It's kind of like during the pandemic. If you remember, toilet paper got out of control, right? Even though COVID had nothing to do with stomach issues, right? People were stocking up on toilet paper. So if you remember, do you remember that toilet paper prices would skyrocket on Amazon?
Irrational behavior. Yes, I remember.
So it was all behavior driving the prices, and these companies are going to charge as much as they can possibly get away with. And so I don't know the answer to that, though. I think you're right. There's going to be irrational behavior until society becomes rational and pays what things are truly worth. We're always going to have price fluctuations like this. And it's a good chart. I appreciate you showing it. Again, I don't like charts, but it's crazy. I mean, ramen noodles went up almost 100%.
Yep. Bleach.
Which is nuts.
I know. I did
At least
appreciate
almost
though
100%. Yeah.
exactly the point that you're making about behavior, though. The other item that was included in this article that I didn't really talk about is the specific people that they interviewed and how they've adjusted their behavior. And I thought it was interesting, Jake. They talked about several people that have observed, like at the dry cleaner, somebody else who talked about the deodorant that they've bought, for 10 years and how the price has doubled. So now they've adjusted their behavior and they're looking somewhere else or they're making changes because they just don't think it's appropriate to pay that amount. And they don't feel like they're getting value for what it is that they're spending. And I think that's really the first step to the point you're making earlier is adjusting behavior.
Right. And I think this is an opportunity, actually, Cory. Capitalism many times gets a bad rap. However, I think this is an opportunity for other companies to step up and be what's called conscious capitalists. And they don't need a price gouge and they don't need to do this collusion and fix all the pricing and do all that. They can develop really good products, market them, undercut the pricing and enter up and take market share from people. And again, it's all about behavior. And we as consumers need to reward those companies that do that. And to me, that is an example of why capitalism can be good. I would love to see leadership from these CEOs and corporations take that on and become that way. And I think that's a true opportunity. And it'll be exciting to see who emerges in that space. Because I think
That's
it is
good
an opportunity.
perspective.
Yes. Well, thank you. All right, good. Let's go to the next one, Cory.
4 ways to lock in yields above 5%.
Yes. So you've heard me talk about this on the show. And a quick plug, we've got an exciting offer with Goldman Sachs where we can get you around 5% as of the recording of the show on your savings account. However, this is not what we're suggesting as an investment strategy. That would be used on money that you don't want to invest. What this article talks about, Cory, are ways to lock in 5% from an investment standpoint. Now, very big and clear disclosure here. I am not recommending any of these as investments. Before you do any investing, you should meet with your wealth advisor who's acting in a fiduciary capacity. So I don't want anybody to go out there and buy any of these things. I'm just listing off what the article talked about, and I'll give you my opinion on them. So the first one were multi-year guaranteed annuities. We don't like those, Cory.
No,
So again, annuities typically come with high fees. They lock up your money. And again, this show's not investment advice. However, I am not a fan of annuity. Cory, if you ever want me to go on my soapbox, let me know, and I'll go on my annuity soapbox.
One of these weeks, we'll get there.
Yeah, we'll get there. The other one I don't know if you've heard of these, Cory, defined maturity ETFs, which stands for exchange traded funds. Have you heard of these?
I have.
Yeah, I don't know much about these. Again, because at Falcon Wealth Advisors, we don't use products for our clients, but basically these actually function a little bit like bonds. So you'd buy an exchange traded fund that actually has a maturity date. And for the individual investor, this may or may not be a bad idea. It's probably going to be cheaper than an annuity, and at least you get a maturity date with it. So again, not recommending it. I'm just saying what the article pointed out. Preferred stocks was the third one, Cory. Preferred stocks we have used in client portfolios before. These are not stocks and they're not bonds. Nice and confusing. They're typically higher on the payback scale when it comes to stocks. So they're in a higher pecking order. If a company goes bankrupt, preferred stock holders would get paid before common stock holders, but they're not as safe as a bond. So they're kind of in the middle is the way you would think about it. They typically pay pretty decent dividends. Again, not a recommendation, but something to think about and consider, something that our team actually considers. And then the other one is exchange traded debt, also referred to as baby bonds. Have you heard of these, Cory?
I have.
Look at you. So a baby bond would be a cheaper version of a bond. Normally, bonds are issued in increments of at least $1,000. These baby bonds might be $25, but an individual retail investor that maybe doesn't have thousands of dollars and only wants to put $25 in a bond, this may be a way to get access to that. However, again, be very careful because there's a lot of risks still associated with bonds. So I wouldn't recommend you go out and do this on your own. So my point is now, go ahead, Cory.
No, please.
So my point is, though, now is the time to consider in your investment portfolio, how can I lock in some of these 4, 5, 6% rates that some of these bonds or investments are yielding so that if, we don't know when, but if rates go back down, I don't want my fixed income investment portfolio going back down with rates. So the idea is that you want to lock in 5% for as long as you can, as safely as you can, and not be subject to interest rate risk when interest rates perhaps do fall. Again, we don't know if they're going to do that, but they could, just like they could go up. So again, you want to stay diversified. You want to meet with your financial advisor, your wealth advisor, and you want to align all of this with your financial plan. But go ahead, Cory, what were your thoughts?
No, I was going to ask you if you can just expand on why someone would want to lock in those yields as opposed to putting the money in a high yield savings account that pays 5%.
Right. Good. Thank you, Cory. The high yield savings account interest rate is variable. So with our account, Goldman Sachs has the right to change that in April. They could lower it to 1% in April. So if you put $100,000 in this account because you thought you were going to get 5%, that's great. But again, Goldman owns that interest rate. And so they could drop it to zero. So that's why you don't want to do it with investment money. You want to do it with money that you don't want to invest, that you want very safe and very liquid, and you're not worried about necessarily getting the most return for the longest time frame. You're looking to get something now for the short term. So that's why you wouldn't put it in there. Good question.
Yep, good.
All right, perfect. Let's go on to the next one here. All right, Cory, expense versus investment.
Yes, this
Did we
is
talk
from,
about this? I think we talked about this. But
we
anyways,
talked
go
about
ahead.
a different, we talked about something. We talked about risk versus exposure. This is expense versus investment, which is from Carl Richards, the same blogger, and this is from his LinkedIn page. But this was another interesting concept. And the real takeaway from this that I wanted to share with you here today, Jake, and kind of just get your thoughts on, and the point that he was making is don't just assume that every expenditure is an expense. Stop and think about it. Is your expenditure an expense or is it an investment? And he highlighted like a strength or a conditioning coach is a great example. It can be a smart investment, but sometimes the smartest investments are the hardest ones to make if we are not able to see the real return that they provide. And my takeaway from this was you should align your money. You should align where your money goes with what's most important to you. And that's when expenses become investments.
Yeah, very good, Cory. I swear we talked about this, but it's okay to bring it up again because it's an important topic. Just like, and I think this is why, because people might laugh at me for this, Cory, but I pay someone to mow my yard, right? And to be fair, I don't mind mowing my yard. I wouldn't mind doing it. However, I feel like that money that goes towards a landscaper is money that I'm investing in time back to me and Rachel and Falcon Wealth Advisors and Einstein, right? So, and golf. So again, yes, it costs money and it's not cheap necessarily. However, I'm not laying on the couch while they're mowing my yard. To me, then that, Cory, would be an expense, right? If I was literally every time they mowed my yard, just literally doing nothing, scrolling on
Yeah.
my phone,
Yes.
that's an expense, right? But to me, it's an investment because I choose to spend that time doing things that I'm either better at, more productive, or that I spend time with my wife or my dog or golf or with clients. So, and I love the one you brought up, a gym membership. I mean, what better way? That's not an expense as long as you go to the gym, Cory.
Exactly.
Because if you're paying Planet Fitness, whatever it is a month,
$10 I think that's what it is, right?
if you're paying that and you never go, or you're paying that Peloton subscription, but you haven't been on it, right? That is then an expense. Now, we're always going to have expenses though, right? You're going to have to pay for food and electricity and water and gas and taxes, right? Again, I wouldn't consider those necessarily investments, I guess, unless you're buying nutritious food, if you're buying organic food and it's healthier for you. But I love it. And I think his article also talked about it, because I think I read this one too, Cory, is that you can't say everything is an investment.
Right.
You have to truly align it with productive things that are enhancing your life, and then realize that you're also going to have some expenses. But it's another way of looking at it, and I appreciate you sharing that today.
Yeah, I kind of just reframed that perspective because he talked about the strength coach that he hired, Jake, and how he was almost embarrassed by how expensive it was when he first hired him. But then he talked about how he noticed a shift in his mindset and his work and his energy levels, et cetera. And because of that expense he was paying, he realized that was an investment that was making him more productive in other places. And that just kind of flips the script on the way you think about how you're spending the money in the first place.
Yes. Yes. And it all starts with meeting with your wealth advisor and creating a financial plan. And actually, our financial planners are happy to go in the weeds with you and develop a very detailed budget analysis and look at where you're spending money. And then you can classify, well, this is an expense or this is an investment.
Yep, that's
I'm
good.
spending money on this gym membership or on organic foods or on lawn care because I'm using that time or food or whatever to enhance my life. That's truly an investment. Really good. All right. We got time for two more, Cory.
All right, Jake, is your 401k destroying capitalism?
Speaking of capitalism, right? I brought that up already.
That's right.
So this article, Cory, I think is fascinating. I want to get your take on it, but let me tee it up for you. So the article argues that most, especially younger people, most people investing in a 401k are now defaulting into these target date funds or index funds, which is like the entire herd all investing the same way. And one of the arguments is when all these people go to retire and they're liquidating, they're going to all start selling at the same time. And so the point of view is that perhaps is a little socialistic and that everybody is just kind of moving in one direction for everything. If you buy an entire index, you're not really investing in any one company. And so I think the big issue, though, I want to hear. Well, first, let me hear your take on that before I go into my other issue with this. What's
I
your
think it's
thoughts
really
on that?
interesting. This is the rise of index investing and passive investing over the last 10 or 15 years. I'm sure is probably what has led exactly to this post. But it is interesting that the idea of people saving and investing for the long haul could be perceived as destroying capitalism.
Yeah, well, the most important thing, though, is they're using these index funds,
It's the
right?
products
These
they're
broad
using.
index funds. So they're not actually investing in companies, or they aren't technically investing in companies, but they're investing in all the companies, right? So my takeaway was also, Cory's, for individuals not to get caught up in this. And I would encourage people, this is my opinion, but I would encourage people to hire a wealth advisor that will go select individual stocks and bonds on their behalf, because this is a serious decision, Cory.
It
And this
is.
is not something that I think people should just ride the wave and do what millions of other people are doing, because your retirement is custom to you and your financial plan and your family and your goals, right? And your risk tolerance and your income needs. And it's not something you should be putting in a broad market. It's just not. It's too important of a decision, and the implications and the consequences are too high for people to just ride the wave. What do you think?
That's good. I think that's really good. And I mean, I'm just thinking that through, like what I guess the core idea behind passive investing is that if investors believe the market's efficient and they're just buying the index, that the market has already sorted out what companies are worth and they're just sort of riding the wave. But I agree with you completely. That seems like a very ineffective way to plan for how you're going to have your money invested in retirement, particularly like when the paychecks stop. That is when the investment component of what people do is that much more important. And I don't think that just following what everyone else is doing and investing the same way as the rest of the herd is probably the right thing for most people.
Right. Well, and you made a good point there that we would hope that the markets are efficient. However, Cory, if everybody's just buying every stock, no matter if it's good or bad, then that makes the market inefficient. And that's the problem, actually. And that's what's
Right.
destroying
Yep.
capitalism, is that if you're buying an index fund, and I don't know, I'm not gonna name specific names. Compliance doesn't like that, and I agree with that, because I don't want people thinking that
Sure.
I'm recommending a buy or sell. But let's just say ABC company, let's say they're crummy. Let's say that they do harm to people and the environment, and they cheat on their taxes, and they pay all these fines, and they lay off their employees. They're just a crummy company. But you know what, Cory? If this company's in the S&P 500 and you're buying the S&P 500 index, you're investing in them, right? And so that's, again, why I don't like it. I think you need to use fundamental analysis. I don't think you should do this on your own. I think you need to hire a professional that's doing it full time for you. I just don't think you should be buying a broad index. I don't think that's doing anybody any good. So anyways, good. All right, time for one more, Cory. One more quick one here. Cory, want to retire early? Consider these costs before calling it quits.
Yeah,
What do you
so
got?
Yeah, this was from Barron's. And the first thing I want to point out is really the main expense that was highlighted in this article, Jake, was really healthcare. It wasn't as if there was a lot of expenses that were highlighted. And I think we talk on this show, and you and I both talk with clients about how important of a consideration that is for someone's retirement. But what I found pretty interesting about this, and what my main takeaway was, is that one, surveys find that many people retire earlier than they planned. And the majority of them, it's typically due to layoffs or health concerns for themselves or their partner. So what someone has had planned for retirement and reality aren't always aligned for one reason or another, but a lot of times it's not chosen. Health insurance, as I mentioned, was the primary cost that was emphasized here. But my perspective from this article was that it is all the more reason for people to save for retirement and invest and save for the future while they can focus on their health and ultimately avoid lifestyle creep, which is kind of aligned earlier with what we were talking about, the expenses versus the investment, making sure your money's going where it has the most impact for you. Because I do think that is crucial.
What do you mean by lifestyle creep?
It means that as your expenses grow along with your income, that the closer that you get to your income going away in retirement, the more difficult it can be to maintain all of those expenses. So it's basically just spending more money as you make more, as opposed to maybe saving or investing more as you make more.
Got it. So you're saying when clients get that raise, to not necessarily raise their spending, to keep their spending the same.
Where appropriate, yes. But I think almost more, maybe even more important from my point of view, Jake, than that is when somebody is going into retirement, or even if somebody's established their financial plan, they're still working, they're not yet retired. It's really important to understand what their spending actually looks like if they weren't working anymore.
Right. Good. Well, thank you, Cory, for that last headline. That is all the time that we have for today's episode. Any final takeaways or calls to action for our audience?
Make sure you're sending us articles, please. Jake and I like to debate and discuss what it is that anybody who's watching or listening to this show is reading themselves. So make sure you send it to Luke@FalconWealthAdvisors.com, and we'll make sure we talk about it on the show.
Yeah, good one, Cory. Yeah, please keep sending in your questions and comments and articles. Every now and then a chart is okay. Again, I'm not a chart fan. I don't like them, but it's kind of
we
funny.
need to do the chart of the week.
So we'll keep looking at them. But thank you again, as always, for tuning in, and we hope all of you out there have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, FalconWealthAdvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.